Hi everyone, I'm Shilpa Gupta, Head of Investment Products and Insurance at Mirai Asset Share Khan. And today we are in conversation with Mr. Manish Gunwani, Chief Investment Officer Equity at Bandhan AMC. Every investor wants answers to three questions. What are the opportunities? What are the risks? And how should one stay invested among these uncertain times? And there is no better person than Mr. Manish Gunwani to help us explore these. So, Mr. Gunwani, thank you, and it's a pleasure to have you with us today.
Thanks for having me.
I would like to start by zooming out and looking at the broader picture first. As a CIO, you have a daunting task of constantly balancing between the risks and the opportunities. So, when you look at today's market, what excites you the most and what concerns you the most?
Okay, so as a investor, you should actually like stocks which have not done well because that is where most of the time the value is. And there is no lack of opportunity from that sense, in the sense that over the last 2 years, we've seen the market basically not go anywhere. And within that, there are a lot of stocks which in last 2, 3 years are down 10, 20, 30%. So first of all, in terms of intrinsic value, there is a fair amount of hunting you can do in this landscape. And on top of that, the domestic economy actually has held up well. The global economy led by US also has held up well in spite of a lot of narrative about challenges, right? Like when the tariffs came in, there was a lot of concern it will create a US recession, etc. When the Iran war came in, there was a lot of concern that it will lead to a massive slowdown in global economy. That's not happened. So in a fairly resilient economy, you have a lot of stocks which have not gone anywhere for 2, 3 years. The earnings, the price to earning multiples have derated. So as a stock picker, that is a landscape you like. Now, in terms of concern, I think the challenge, maybe in a lot of our lives, is the same thing which is AI, because all of us, I think, need to grapple with this huge transformative technology.
Correct.
There are some who believe it will kill lot of jobs, and particularly because India is very reliant on services exports. And jobs are particularly those which can be cannibalized by AI. Or this could all be hype. I mean, it may happen, but it may take much longer than some of the people think. So as an investor, I personally feel that the biggest challenge for us is to predict how AI will play out and how much will it impact. And I don't mean AI in the narrow sense of just, Claude or
Yes.
open chat GPT. Look, AI will obviously feed into autonomous driving where, drivers may lose jobs. It will feed into humanoid robots which may replace a lot of manual labor. So when I say AI, I think I'm kind of referring it to the broader landscape where it may impact our society. And that's what I'm saying, that more than economists, nowadays when you listen to historians or political theorists, you get scared because they seem to paint a very dystopian future
About
where
this.
people will struggle to get jobs. All this might be hype, I agree. So I think you just have a base thesis, but you keep calibrating it as you go along because AI is changing virtually day to day, month to month. Unfortunately, that's why I think you can't do buy and hold investing right now because there's too much of change in the world.
Change which is happening. So one needs to be very agile.
Yes.
So, taking a cue from what you just said about the heightened geopolitical situations, so that is on every investor's mind, though, as you've said, that the markets have been resilient, but how the current geopolitical development is shaping your investment outlook?
Yeah, so sometimes you have to abstract away from what's the particular incident which keeps changing. So it was Venezuela, then Iran. I think at core is that you have a traditional superpower and you have an emerging superpower, and they're obviously not seeing eye to eye in a lot of things.
Correct.
And therefore, you may have separate incidents, but the underlying theme is these two superpowers probably trying to assert themselves. The sad part of that interpretation is I don't think we'll be free of geopolitical incidents.
In
It's
the near
not that
future.
one incident finishes and then we say it's all done, right? It might keep recurring in different regions.
Correct.
So first of all, there are the direct economic impacts that you have to assume that defense expenditure globally will go up. It will stress out fiscal deficits of the governments globally, which you're already seeing. You can also play some defense stocks just as a corollary of that. But I also feel it will rub off on things like currency, for example.
Correct.
Because ultimately, if let's say you believe, and that's a view, it may or may not be true, but if you believe that China will be able to stand up to US and portray a more sober picture of institutions and stability in policy versus US, which seems to be a bit volatile at this point of time, then you could also argue that the yuan, which is fundamentally a undervalued currency, could appreciate over a time
From the current
structurally,
levels.
right? I mean, if you're talking of 5-7% appreciation, maybe in 5 years, 30% appreciation, right? So there are various repercussions of this geopolitical thing, but I think the broader theme is China versus US.
Okay. And how should a normal Indian retail investor kind of sail through these uncertain times?
By investing in mutual funds.
You put it so nicely and
We
subtly.
take the pain out of we are the kind of doctors, right? You go to a doctor for treatment. No, but on a more serious note, obviously, this is investing is becoming more competitive, more efficient, and it's good, I think, for people who can't dedicate a lot of time to outsource it to a professional.
Right. So, if somebody has to build their portfolio today, what is an allocation which you would be suggesting in terms of large cap, mid cap, or small cap?
Look, we've been fans of small cap space for a long period of time, and our view stems from okay, we acknowledge that it's more volatile, so you need to come in with 3 to 5 year kind of time frame. But the reason why we've been saying this is that a lot of people traditionally look at these market cap, looking at aggregate earnings and aggregate price to earning multiple. So people say, look, mid cap growth is 19%, but P is higher, so we should prefer it over large caps, or the reverse, right? Large caps earnings is this much, P is so much, so it's attractive, which is fine. I mean, that is important, of course. But particularly in small cap, I don't think that applies because the universe is 700, 800 stocks which institutions can invest in. So there's no point looking at that vast a universe and talking about aggregate earnings, particularly also because they're not as researched as the large and mid. So first point is that for small caps, aggregate earnings have limited value, aggregate price to earning multiple has limited value. But more fundamentally, just kind of taking on from what we're discussing, essentially, I think the index composition changes in line with the composition of the economy, right?
Correct.
And I think from 1990 to 2020, the global economy and domestic economy had a fairly homogeneous kind of macro. You know, peaceful world, India having best demographics, India discovering IT services as a big export driver, and India's base being so low that a certain growth was given the demographics. I think now the world is different, that we have more geopolitical friction. The government budgets globally are very stressed. You obviously don't have free trade. I mean, you have free trade, but it's much less than what it used
What
to
it
be.
used to
Every country is worried about the supply chain, so it's duplication of capacity. It may not make economic sense, but it's driven by political insecurity. So this is a very different macro. And going forward, between AI and geopolitics, we think that the velocity of change will be much higher next 10 years than the previous 10 or
what
20 or
then
30
is.
years. And whenever there is more change, you will get new themes, new sectors emerging, which will obviously start from the small cap space. So our sense has been that we are living in an age of big transformations, and therefore small caps make more sense than large caps.
So, when you're saying in small caps, are there any areas or any sectors in the markets where you see that the markets are overly, optimistic or pessimist than what you think?
Yes, there are always sectors you feel are overvalued and sectors you feel are undervalued. I generally feel, and maybe that's not particularly to small caps, but I do particularly feel that some of the uh, power equipment names look very stretched to me, given that because of this AI narrative, and there's a genuine earnings growth, but I'm just saying that that earnings growth may last 1 or 2 years more, but the kind of multiples we are paying is very high.
Very high.
I also feel a lot of consumption stocks, even though they've not done well over last 2 3 years, but the multiples are still very high. Given that our demographics is also a bit close towards peaking out today than 20 years back, right? So the penetration-led story is not there in a lot of consumer goods. So these are areas where I generally think there is a bit of overvaluation as per my perspective. On the other hand, a lot of domestic cyclical sectors, I think banks, insurance, real estate, they look pretty attractive from a risk reward perspective.
Now, let's talk about the new fund which you've been getting. So, for new investors, if you could just help us understand what is a contra strategy.
Yeah, contra is basically a way of thinking where you say that primarily you're investing in stocks which have been ignored or a stronger word, hated by the market, right? So there is content by the market for these stocks. They probably have underperformed for either 1 year, 2 year, 3 year, 5 year period. But where we think there are reasons to believe earnings growth will come back or the P multiple will come back. So I'm not saying every stock which has not done well is a contra pick, because obviously you have to do research to figure out whether it is worth betting on that sector or stock coming back. And there might be some which are structurally impacted, so you don't want to touch them. Uh, but basically, it is about investing in stocks or sectors or themes which are ignored or hated by the market. Now, a lot of people ask us, how is it different from value? And that's the natural question. So the way we think about it is all value is contra, but all contra is not value.
Right.
Because, see, there might be an internet platform stock which could drop 50%. But where there are no earnings, there is no traditional numerical value metric. But we think that's contra, because as long as it's hated, and if let's say in 3 to 5 years we feel that the earnings will justify the current market cap, then we think that is contra as well.
Okay. So when you're talking about, then means that the stock picking becomes very, very important,
Yes.
right? So then how would you kind of distinguish that if it is just out of, it is market is not liking that particular stock, or, so it's a contra bet, or there could be some structural challenges being faced by
Yeah, so that's the research and art of fund management. You don't want to buy company which is producing fax machines because no one's ever going to use
Using
fax machine, right? But you obviously want to buy something which is going through a cyclical downturn, and when the profits come back, it is very cheap on normalized profit. So that differentiation obviously will happen through your research and art of fund management.
And how would this fund differentiate itself from the other diversified equity funds available in the market?
So look, the universe is the same, but this will be much sharper in the sense what we call active share, how much it differentiates from the benchmark. See, 0% active share is you're perfectly replicating the benchmark. 100 is where you own everything which is not there in the
In the
benchmark.
benchmark.
So typically, if you see, most diversified funds would be in that 40 to 55% range. This is likely to be in the 50 to 70% range because when you say contra, you are kind of excluding all momentum stocks. You know, stocks which have done very well for last 1 or 3 years. You're excluding that virtually from your universe, right? And you're not binding yourself to a benchmark centric way of thinking. So let's say there is a stock with 5% weight in the benchmark. A lot of funds will have 1 or 2 or 3% just for index matching. We are not bound by that, right? I mean, when you're saying you're contra, if that stock is done well, then you can be zero in that 5%. So basically, it's a much more aggressive stock picking fund versus most of the diversified funds.
Okay. And who would be an ideal investor for this strategy?
Look, this is clearly a slightly more riskier fund than a normal flexi cap or a normal large mid cap kind of category. So the investor needs to have a bit more patience. Also, because when you're buying contra stocks, what is happening is you're buying sectors or stocks which are out of favor, and will it take time for these companies to turn around or the sectors to turn around. So ideally, it should be investors with a bit more patience than the normal diversified fund.
If the investors listening to us today, what is one thing which you would want to tell them about contra investing when they are investing in future as a key message you which want to leave with the investor on contra?
So what I would say is this is potentially a style which can deliver very, very healthy returns and outperformance versus benchmark. But come to this fund with a bit of patience, with a bit of attitude that things may not work out in 6 months or 1 year, but on a 3-5 year basis, it should ideally do well.
Okay. Thank you. It was lovely to have you, Mr. Manish, today.
Thank you. Thanks for having me.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.